Good morning, everyone. My name is Michael Nadrich, and I am the co-CEO of Amerivet Securities. And I have the great pleasure to be joined by my partner, CFA, all things Fed, liquidity, and rates, Gregory Faranello. Welcome, Greg.
Michael, good to see you. We're almost on 3 years here.
3 years, which is incredible. Yeah. And for those of us who've been following us know that not only do we enjoy doing this together, but there's some meetings that are paid attention to more than others. And this is certainly one of those. So, let's jump right into it, Greg, because there's a lot of important stuff. Let's discuss some of the dynamics since the January meeting. There's been a lot of back and forth between 25 and 50. We've discussed it internally and with clients a lot. You've been pretty steady at 25, and I think, maybe now with some of the geopolitical stuff, it's probably going to play out that way. What's your thoughts here?
Yeah, no, it's a good question. Look, it's going to play out 25. I think the chairman, he preempted his committee because of the volatility in the marketplace. But having said that, even myself, I've been committed to that. I've been committed to that from a slightly bigger picture perspective in terms of some of the geopolitical dynamics that have been playing out. But with that, I will say there have been some pretty significant people in the financial services industry that indicated recently publicly that the Fed was ready to go 50. They were ready to go 50, irregardless of some of the things that we're seeing. So it's very real. I think it just highlights the fact that the Fed is extremely concerned here about inflation, and they want to keep inflation expectations under control.
Yeah, it's really interesting times. I mean, I haven't seen this much chatter and speculation about 25 versus 50, in quite some time, right? I mean, it's fascinating. So let's talk about, what you expect to see in the updated summary of economic projections, the statements and the presser in general.
Sure. No, thank you. So the SEP, it comes out quarterly. It will come out again this week, tomorrow. And I think what you'll see from the Fed is kind of what we're seeing together here, which is lower growth expectations, given what we're seeing, I think, geopolitically right now. And at the same time, I think you're going to see inflation expectations are going to be risen. So in the end, I mean, we have certainly favored a flattening yield curve over time here. I would say over the last 6 months, I think that's what you will see from the Fed practically in terms of what they put forward. But then where is the Fed in terms of 2022 and 2023 and 2024 in terms of their projections for the Fed funds rate? So you and I have talked about this over time. I think if you go back to pre-pandemic, you look at a funds rate that was 150. I think the Fed is going to project somewhere in that range for 2022. We don't know if they're going to get there or not, but I think that's what they'll project. And then I think what you'll see in 2023 and beyond that is probably a trajectory that's a little bit steeper than what the market's pricing for. So what do I mean by that? The terminal funds rate right now, if you look at where the market is pricing, is, and Jay Powell has said he thinks the terminal funds rate is anywhere between 2 and 250. If you look at the long end of the US yield curve, we're much below that right now. So I think you will continue to see a Fed that is saying, look, we're probably going to go a little bit less than the market is anticipating now, but over time, we've got some challenges here with regard to inflation. So that trajectory, that pathway, if you look at that curve, if you look at the market curve, Mike, we're going up and then we're coming back down. And if you look at the Fed's projection, they're going up and they want to continue to go up. And I think that's a battle that's going to have to be fought out over time.
Yeah, makes a lot of sense. So I want to get back to geopolitical for a second because it's so front and center, and the Ukraine situation is just devastating, and the bravery of the country, men and women there, is just honestly legendary. But how's the war shifted the central bank's mindset? Right, there's got to be a little shift, and I know there was a recent testimony in Congress where this was touched on. Can you give us an idea of what you're thinking on that?
Sure. So I think if you if you look toward Europe, if you listen to the ECB, even if you listen to the Fed, I think what they're saying is these dynamics around the war are more inflationary than not. I mean, the markets are not trading that way today, or given that mindset. But when you look at supply chain, when you look at the dynamics around what's going on globally, my view is, and I've shared this to clients over time, at least in the United States, we need to do more here. Period. It doesn't matter who the president is. We need to do more here. We will need to do more here over time. I do think that will be inflationary over time. It's not going to be the issue for the Fed meeting right now, but from a bigger picture perspective, how I see the war, how I see the dynamics playing out with regard to Russia, Ukraine, China, obviously now getting into the mix. When we need to do more here domestically, which we do, it's going to be inflationary. And it's going to be inflationary because we're going to need to hire workers and build more here and pay people more over the long haul. So I think that is a challenge for the Fed. I think it's a real challenge for the Fed. It's not going to be the way they start here this week, but I think over time, I think this will become a little bit more and more apparent.
Interesting. So, Gregory, you and I have been students in the markets for over 30 years. And one of the things I always find fascinating is Fed's done nothing yet. Now, we all believe, obviously, tomorrow they're going to go 25 basis points, but the market's volatility has been, dramatic. I think NASDAQ's down like 22%, and the S&P is probably down 11 or 12%. How do you see this playing out for the rest of 2022?
So I sat there late last year and was watching the markets, watching the signaling. And you and I talked about this even in September of last year when some of the global central banks made their pivot. And I was amazed at how markets in the US were not reacting. And now they are. And that's, in general, this is what you will see from central banks. This is how they signal, right? So if you listen to Chair Powell, if you listen to the Fed, they are actually happy right now that things are moving in this direction. So take mortgage rates, for example, 100 basis points higher within a very short period of time. You look at credit spreads. We talk about this every single day, much, much wider. So I think so long as it's orderly, and we've had, look, liquidity is certainly I would say a challenge here. There's no question about it. We look at liquidity in treasury markets very, very closely. And it's certainly something to keep an eye on. But from the Fed's perspective, it's not all jawboning, right? They are jawboning a little bit, but they need to, I think, keep a close eye on market liquidity, and they will. So they have moved markets, I think, short term to where they want markets to be because they're tightening financial conditions. The challenge is financial conditions, when you look at it from a bigger picture perspective, they're still really, really loose. So I see a Fed that will continue to utilize their tool set. Balance sheet is included in that, interest rates, obviously, but they need to be careful. They need to be careful. They need to move, in my view, methodically. I've said 25 basis points, just keep going, 25 basis points until you see that trajectory of inflation coming down. Keep markets calm short term, because we have many, many things right now that I think are going on that are outside of the Fed's control. Just be steadfast, be very transparent. That's what Jay Powell has done, and I think that's what you'll hear from him this week.
Yeah, I was just going to touch on transparency, as we finish up here today, and for those people who've been watching us for years together, I always like to kind of put you on the spot a little bit. It's amazing to watch, 10 to 12 months ago, no one was calling for any raises. Now we see as high as 9. I agree with you on the consistency of 25. Here we sit in the middle of March. How many do you see this year?
Yeah, so I see the Fed getting back to 150, which is where we were before the pandemic hit. So that's 6 ish. It could be a little less, but it's not. I don't think it's going to be much less. I think they're in general. I just think they're, and I think I think Powell knows it. They're just behind the curve here. And I hate to use that expression, but that's how I feel. When you look at their emergency measures of what they've done over time, they have some catch up to do here, but I don't think they should catch up by hitting the market with things like 50 basis points. And because I do think we're fragile in other areas in terms of what's going on right now. So certainly 5, 6 rate hikes, I think, this year. And it's hard. I've had some people reach out to me recently. They said, you're crazy. The Fed's going to go once and they're going to stop. They can't afford to stop. They need to, when you look at the inflationary dynamics, inflationary expectations, that's their biggest risk in terms of losing that. So although we look at what we look at right now, and we look at inflation expectations are at a certain level, they are at that certain level because we are priced for the Fed to do a certain thing. And so they need to deliver here, I think is the point. So I'm going to go with 5 or 6. You can hold me to 5 or 6.
Yeah, no,
but
I think that's where I thought you were going. I was just laughing a little bit because I think the people who call you and say they're going to go once and stop should probably go do a history lesson of inflation in the 1970s, right? Greg, I enjoyed it. I look forward to it next time. I wish everyone continued safety, right? And a great week ahead. Thank you.